Okay, here we go. Good morning, everybody. Thanks for jumping in. We got people still coming. Kathy, let them in. Appreciate you guys being here every Tuesday. If you are a guest with us, welcome. You're always welcome. We do this every Tuesday, same Zoom link, same time. Most of us are with EXP, but we're part of a group called Freedom Team. We're about 3,000 agents all across the country, 7 other countries around the world. But this is not an EXP event in any way, shape, or form. This is just something we do every week to help the agents just increase their production. Ways to get more leads, scripts, dialogues, just all kinds of things that you can do to just enhance your business. We're all working on growing our businesses and taking them to new levels. The market being challenging. One of the things that is coming up with a lot of this is the idea with the rates being so high is being able to assume mortgages. It's funny because 21 years of doing this, my wife is actually, we work together. She's actually in a deal right now where that's the process. She's got she's got the sellers. Wait a minute, let me think. Which deal is this? She has the buyer. The buyer is assuming the mortgage of the people on the house that we're buying. So we're actually working with a company here in town called Assumption Solutions. They're here in Colorado Springs. What we're going to do here today, a little bit different than what we normally do. Normally we bring somebody on and they have a topic and we mastermind on that topic. We teach on that topic, whatever. We're going to actually show, a video that's kind of a training that this company does. Now, I do want to emphasize up front, like this is in no way like any kind of endorsement or anything for this company. He's going to talk I think there's a couple minutes in there where he does talk about, how if you want to work with them, they do stuff all over the country. If you want to work with them, here's how much it costs, this and that. But the main reason we want to show this is to give you guys just a good training on assumptions, how you could use assumptions to get more listings, and ways to market homes that have assumable mortgages. Things that you could do with your buyers if they are eligible to buy a house, where they could assume the mortgage. I would tell you guys, talk to your lenders, you'll take some notes on this video because you'll pick up some things here that you could carry on with wherever you are across the country. You could definitely get in touch with these guys at Assumption Solutions. Craig O'Boyle, great agent here in town. I've known Craig for a long, long time. He started a few years before I did, but started this company way back when. So anyway, Kathy, do you want to add anything to that at all before we get going?
No, I'd say we get going and then, we'll just kind of talk about it afterwards and kind of, all together just mastermind a little bit around it. And, in this video, he's going to talk about it as agents. For the last 20 minutes, he talks about how do we as agents, kind of market this. So,
right. So I'm going to play this. I will shut it off. I think when he gets to the Q&A part, because there's really not much Q&A that goes on there. So I'll shut it off then, and then we can all talk and answer questions. Jason Aaron's, good to see you, buddy. How are you? Good to see you guys. So let me share the screen and make sure everybody can see this. And let me just double check the audio. Yep, we're good to go. So let's go ahead and play this. Okay, here we go.
Okay, we're going to get started. So I am Craig O'Boyle. I am coming to you today for Assumption Solutions to present on the VA, FHA, and USDA assumption process. So give you a little bit of background on me. I'm a Colorado Springs realtor. I have been in the real estate business since October of 1995. I got licensed as a 19-year-old kid. So I've been working on a little over 27 years now. And I came at the perspective of Assumption Solutions from a realtor who spent years and years sitting in front of clients and especially VA clients in Colorado Springs, where we have a lot of military, who were closing on their home, and the topic of the assumable mortgage would come up in their deed of trust. And I always would say to clients, hey, if you ever find yourself in a situation where the rates are rising and you have a significantly lower rate than new buyers can obtain, you will have an asset. And so obviously with the market shift that came to be in 2022, rates effectively doubling, I saw the opportunity with a partner to dive into helping people process mortgage assumptions. So that's my background. I also want to introduce our head of processing, Amy Cavender. And Amy, why don't you introduce yourself and tell the folks about you?
I'm Amy Cavender, and I have been in the business for about 30 years as well. My background is as a mortgage lender. And so I bring the knowledge of what it takes to qualify on the assumption side, because they are a little bit different, and we'll get into that in this presentation. But Craig asked me to be a part of Assumption Solutions, and so I'm glad to be able to bring our knowledge to you today. Thanks, Craig.
Wonderful. Okay, so let's dive right in so we can get everybody on in an hour or less. And what we're going to talk about today, our agenda today, is covering, what is a mortgage loan assumption? Why is it useful? What types of loans are assumable and who qualifies? The VA, FHA, and USDA assumption process, the pricing that Assumption Solutions charges to be involved and to help. And I want to talk specifically to any of you who are real estate agents about the process of marketing, closing more deals, getting more deals, and being more productive in 2023. So what is a mortgage loan assumption? Well, a mortgage loan assumption occurs when a willing buyer and a willing seller agree to do a transaction where the buyer takes over the existing loan that the seller has on the property instead of getting a new loan. In the past, there was another kind of assumable mortgage called a non-qualifying assumable, which meant effectively anybody who wanted to take over the mortgage could just say they wanted to do it, sign a piece of paper, take it over. Those were something that was in place in really prior to the 90s. I would see a few of them still come around when I got into the business in the mid 90s, but they were few and far between, and they are all gone. The only ones we have in existence today require the buyer to qualify to the same standard as the original borrower who took out the original loan. So something I want to jump in here and talk about why this has become an interesting piece of the market. If you look at this diagram or this the information here, it compares the difference between a $400,000 loan that you could have gotten back in December of 2021 at about 3.1% versus getting a $400,000 loan, a new loan, at about 7%. And the difference in payment is $953 and change a month. So that's why this has become a very interesting topic for us to cover, and why this is a market that's got a lot of potential, because there's a lot of buyers out there who are very payment sensitive, and the idea of saving almost $1,000 a month in a monthly payment is amazing. This will also compare the difference in purchasing power of that same payment. The same payment at $1,708 between 3.1% and 7% is a difference of a $320,000 loan at 7% is equal to a $500,000 loan at 3.1%. All right, what types of loans are assumable and who qualifies? Well, really the only assumable mortgages in existence today are the government-backed financing loans, the VA, the FHA, and the USDA guaranteed loans. They all are qualifying assumable. VA loans, FHA loans, and USDA loans can be assumed by anybody, but let's talk about VA specifically. VA loans can be assumed by both veterans and non-veterans alike. The difference in VA, though, is if an assumption is done veteran to veteran, the entitlement of the two buyers can be swapped, meaning the entitlement of the home seller can be removed and the entitlement of the home buyer, who is a veteran, can be swapped onto the loan. If it is veteran to non-veteran, the entitlement that was used on that original loan by the original borrower will stay tied to that loan beyond the closing until that loan is either paid off or refinanced at some point. That's not an issue with FHA and USDA loans. There's no entitlement issues to swap or anything like that. With all programs, the main qualification that is important to keep in mind is this can only be assumed by an owner occupant. Investors have no way to take over or assume any of these programs. Okay, let's talk a little bit about the assumption process. We'll go through it for buyers and sellers. And Amy, I will say, if you have anything to add at any time, just feel free to jump in, because Amy is the one who is deep in the processing of these. Okay, so first thing to do, let's say you're working with a seller, or you are a seller, is to confirm that you have an assumable loan. Obviously, I'm pretty sure most veterans will know if they use their VA benefit, but ways to do that is look for the note, the deed of trust. You can often get those from title companies, things of that nature, by pulling an ownership encumbrance report, which is something we do here in Colorado. Whatever method you use in your state for looking up the recorded instruments against the property, most of them will show whether or not they're VA, FHA, or USDA pretty prominently, and they're all assumable in that scenario. Then you go to market the property, and let's say then you've got a transaction where the buyer wants to assume it. You're ready to go. We encourage you to connect the seller with us, because at that point, we're going to engage both the seller and the buyer. And I'll talk about pricing, but when they engage with us, we do have a deposit that we take as far as getting things started. We will collect all the documents that we need from a seller that allows us to communicate directly with their servicer to get things going on the processing side with the servicer. You've executed in your assumable purchase contract. We recommend that you allow anywhere from 60 to 90 days at minimum for approval of the assumption. The world of assumptions is new, even for the servicers. And so the timeline, it's not an easy fixed timeline. And anybody who was around through the last down cycle and dealt with short sales will probably think there's a lot of similarities in the process here, because the servicer is the ultimate deciding factor as to the completion of this process. And they've got to be sent all the required docs and review all the required docs to vet the buyer and approve them. And so they don't yet have the people, the processes, or the techniques and everything dialed in. Our goal is to help shorten that timeline, to help keep it streamlined as much as possible. But everybody involved needs to have a good idea that this is not a closing that takes place in 30 days. This is a closing that takes time and effort. Once we've got the seller on board, we've got the contract, we also will get the buyer on board. They'll engage with us as well. We do a little bit of, we say, vetting of the buyer. We don't offer or originate any new lending. So with that, we can't say we qualify the buyer, but we'll vet them. We'll do a soft pull credit check to look and see that, do we believe that they can complete the assumption? That's exactly why we have Amy here. She's been a lender for quite a long time, knows all the guidelines in the lending world. And if we look at the buyer and we determine we don't think we can get this done, we actually won't engage with the buyer. So we don't issue a denial, But if we don't engage with the buyer, it's because we don't think we could get it done, and it probably doesn't make sense for you to stay in the transaction.
And let me interject here real quick, Craig. The reason that we do the initial vetting of the buyer also is just because we have a pre-qualification or pre-approval letter from another lender. These are underwritten differently. So these have to be manually underwritten and follow manual underwriting guidelines. So even though the fact that we've got a pre-approval letter, that's great, but these don't follow automated underwriting guidelines. So that's a little bit different too.
Yeah, so everything about this process is just a little bit different, a little bit more complicated. Ultimately, we gather all this information from both parties. We do it in a very secure fashion through a secure portal. Another reason that it's good to have somebody on your side who's used to handling secure client documents with regards to their financial information. And then we deal directly with the servicer by getting them what they need in the fashion that they need so they can review all the documents. Like we said, I've got in here, expect 30 to 90 days. I would say expect at least 60 to 90 right now. We're hoping that timeline will shorten down as servicers get more in line with doing this. And ultimately, they will issue an approval. And once you have an approval, a closing can take place. The remainder of our fee is paid at assumption approval, which is $500. So our total fee to the seller in helping them is $550. And our total fee, which I'll talk about in a second, to the buyer is also $550. All right, so let's go on here. The process, I'm talking about the process in here, slide for the buyers. For the buyers, obviously, they need to search and contract a property with an assumable mortgage. The buyers, you as their agent, you should also confirm that that loan is assumable. You want to know the things that you want to know. You want to know the existing loan amount. You want to know the balance, the interest rate, the total payment, because you want to make sure that your buyer is ready and has a plan for covering what we call the assumption gap, which is the difference between the purchase price of the home and the loan that they're taking over, because that generally is your down payment, right? And so if your buyer doesn't have all that information and then, you go through this process and they're like, well, wait, I don't have that much cash to come up with. Well, then that's a lot of wasted time for everybody. Once you've got a contract together, connect them with us. They'll sign our engagement letter. We do collect $50 with the engagement fee, and they will then upload all the docs in our template to get to the servicer to review. Now, as far as your contract, you'll continue your real estate contract process as normal, right? Processing of title work, inspections, all the normal functions of a real estate contract. One of the last things that you want in your real estate contract, though, is a loan transfer approval deadline. In Colorado, we actually have this deadline in our contract as one of our standards. Every state's got a different contract. At some level, you want this as a last thing out there. I would say you want to write that somewhere as far out as you can. If you could write it at 90, that's probably smart. But if you've gone 90 days, there may be a reason where you need to extend that. So you have to have talks with your clients that you're going to try and get this done as fast as possible, of course, but you may need to extend your deadlines. But the last one out there before closing is your loan transfer approval deadline. Once the servicer has all docs, has all reviews, everything signed off and sealed, closing can take place. And just like with the seller, the balance of our fee is paid at approval of the transfer. So the buyer and the seller both pay a $550 fee to Assumption Solutions, which I would talk about right here. So Assumption Solutions charges each party $550. The first $50 is paid at the engagement and the remainder at assumption approval. There are other fees that are part of this process. The servicers themselves can charge a fee. What we're finding is that there's no fixed number, but it's generally coming out between probably $1,000 and $2,000. These are all government-backed loans, so it's not like the servicers can just go nuts with their fees. So they have to stay reasonable with what they can charge because of that. The government VA loan program can also charge a 0.5% funding fee on top of the assumption, and unless the veteran themselves has some kind of disability rating where it could be waived. But in most cases, when you do this process, it's going to be a lot less for the buyer as far as cost than that of obtaining new financing. They don't have things like appraisals. They don't have origination fees, all the things that you generally have with a new loan. So, Amy, do you want to jump in with before I talk about marketing, closing more deals, about anything that I didn't cover in the process?
Brian did ask a question that we cover in our live classes. I'm not sure if it's in this, but I'll just go ahead and address it right now. So his question is, when the seller is a veteran, do you recommend an introduction be made to you prior to a prospective buyer being in the picture, knowing that the lender may not even entertain an assumption? So here's how we're handling these. I'm asking that on all listings where you're going to at least address having an assumption as an option. So you've already talked to your seller about, these are going to take 90 to 120 days. Are you okay with that? Yep, I'm good with that. Go ahead and have your seller call that servicer and confirm that it is assumable, okay? These servicers are not real excited about doing them. And so some of them are just saying, nope, we won't do them. Well, especially on VA, well, I can say FHA too. The only time that the servicer really can say that they won't do them is if that loan has been in default or forbearance, okay? Otherwise, that's part of their security instrument. So they can't just say, we don't feel like doing them, so we're not going to, okay? So yes, go ahead and have the seller reach out to their servicer up front just to confirm that they will be allowed to do it. And then if they say no, find out the reason why. And if it's just because I don't feel like it, I want you to call me and I want to get on the phone with that seller and that servicer, and I will fight them. Okay?
Yeah, that brings up a good point that's not in the slides that we have found through trial and error, is there's a lot of misinformation being put out into this marketplace by the servicers themselves. And we have heard things from, exactly what you said, just out and out saying, oh, we don't do assumptions, to we've heard things like, well, a seller can't make a profit in assumption, or it can only be done through a family member or a connection. All that is false. This is a benefit of the loan program that these buyers took out. The servicers themselves may be putting this information out there just because they're ignorant, truthfully, and they don't know what this process really is, because it hasn't been a thing for a very, very long time. The government-backed agencies have guidelines that we, in our introduction letter, when we connect with a servicer, remind them of. Some of those guidelines actually talk about how long the servicer technically has to approve these. Well, they're not quite meeting that yet. We're going to keep working to get them up to speed on that. But my personal opinion is that some of these servicers, with the information that they're putting out that's false, are going to ultimately create losses for people. People aren't going to do certain deals, and they're going to lose money. And these servicers are going to wake up one day with a big fat lawsuit, I think, from some enterprising young attorney who's like, hey, you created a loss for my client because they didn't follow the guidelines that are in place for this. We try to come in behind the buyer and help them fight these issues that do come up. And we've had a pretty good amount of success. We're not afraid to get the VA involved, the FHA involved. Heck, we're not afraid to get a senator involved if we have to, because hurting your client, hurting a veteran, hurting a customer by getting out false information on a benefit that they have in their loan, yeah, we're not behind that. We're gonna fight that all the way. So, anything else you want to add on Amy, on getting the packet, getting processing stuff that we didn't cover?
I don't think so. I think we're on the right track.
Okay. Well, I'm going to talk a little bit more then from the real estate agent perspective of doing more deals. You know, our goal as real estate agents is to help clients be successful, and we in turn are successful. So with the market change, we got to utilize every tool we can to get homes sold, to do more deals and everything else. We're here at Assumption Solutions to be a part of helping you do that. So I want to talk about, how to market to potential sellers with assumable mortgages for listings, market to purchasers who may benefit by assuming a lower rate loan, how to properly market the listings that you have, an assumable mortgage to purchasers, and how to leverage experts such as us to process your transaction. And specifically, we do have an agent tab on our website for some content and for some downloadable things. Matter of fact, this presentation I'm going over with you is downloadable there as well. So let's see. Let's talk about how I have gone about going to try and get more listings and get more clients who have this to utilize this to sell their home. So first things I'm doing, obviously being in this business a long time, I've got a lot of past clients. We're very high military population in Colorado Springs. So I'm talking to them about the assumable nature of their mortgage and what their asset is, what they've got there. I'm very much leveraging social media as well. You should consider doing this, I think, becoming your local expert on this, and record and post videos or share content that we've got on your social media pages about what it is you have. Not only are you benefiting the clients, but truthfully, you're benefiting your colleagues. Because if you want to do more of these deals, the more your colleagues know about them, the more your buyers can find them, and the more deals you will do if everybody's raised up in this. I've utilized some farming tools. I've gone and pulled, just from sales in my MLS, I've pulled homes that sold, in the last 3 to 5 years that sold VA. And I've created farming postcards to send to people talking about the asset that they have, and if they need to sell, how we can help them leverage it. And obviously teaching classes to homeowners is a good thing. We just sent out a poll to all our client database about information that they wanted, and some of them came back with more classes. Your clients are always hungry for, I think, education in the real estate market and topics about what we do for a living. So this is a great one to put out to them. We do have on our website a flyer that you could integrate into a listing presentation that's designed to educate a seller about the asset they have in an assumable mortgage that you can specifically help them leverage. So let's say you're out there competing to get a listing. You could have this flyer in your listing packet, and you might be bringing up a topic to the seller that none of your competition has brought up at all. So, all right. Talking about purchasers, same kind of things, talking to your past client, talking to your sphere. I specifically in 2022 resurrected some clients who were extremely payment sensitive and sort of backed out of the market. because they didn't feel like they could buy a home and be comfortable with the payment with what they had to buy. So when I sat down and I showed them, you know, that content I showed in the earlier slide, the difference between a $400,000 mortgage at 7%, which they would probably get new, versus a $400,000 assumed mortgage. Well, yeah, they were definitely on board. So I have resurrected clients just by educating them and saying, hey, we could just hunt these. So once again, same things, leveraging social media, post real world examples. I think it's a great idea, if you haven't done it yet, to search your MLS and look for homes. Hopefully your MLS has a category where you can check yes, assumable, and get some information, or maybe it's in remarks. I don't know. Our MLS in Colorado Springs has that. To run a search, see what's in there, and share it out on social media and say, hey, look, if you bought this home with a new loan today, here's what your repayment would be. But if you bought this loan and assumed this existing mortgage, here's what the payment is. Now, obviously, you have to also talk about the assumption gap, the difference between the purchase price and the loan assumed. And what I have found is the buyers that I've got that are most interested in it, they're really what I call the move-up buyer. They've got something to sell. They've got a lot of cash or a lot of equity to bring with them. But we all just went through this cycle of craziness over the last couple of years where buyers were finding cash to come up with, you know, overappraised values and all kinds of things. So there's a lot of people out there that can find cash to do these deals.
And Craig, really quick, let me interrupt you. And can I talk about the assumption gap real quick?
Sure.
Okay, so the assumption gap is the difference between your sales price and the amount that is left on the loan that they are assuming. Okay, so let's just, for instance, say that gap is $150,000. Most of these servicers are not going to allow, and I'm saying most, there are some that will allow subordinate financing or a second mortgage to come up with that additional amount. But a lot of these servicers are saying no, that amount has to be brought to the closing table as cash, okay? For those that are allowing there to be subordinate financing, part of your issue is going to be finding a bank that will do the second mortgage, okay? And then I had one servicer tell me this morning that yes, they'll allow it, but that second has to close before our assumption closes. And I haven't dug deep enough yet to know how that would work because the buyer doesn't own it yet, so they can't put a second on it. So I'll dig deeper into that. But the best way for these to work is for that client to bring that money in cash.
Well, and I don't think we have done a single deal where it hasn't been a cash down payment. Matter of fact, where people have approached whether or not they can finance it, the servicers have out and out said no. Correct. And they have a lot of discretion in that, right? There's no guideline, like she said, there's no guideline with the agencies that says you can't do it. But if the servicers don't want to do these in the first place, if you give them a reason to say no, because think about it from the servicer side, right? We get to extend this loan all the way to term at 2.25%, or we could say we could try to deny this thing and we get that money back to lend out at 6.5%. They have a lot of motivation to see these low interest rate loans go away. So
Steve sorry.
Go ahead.
Steve just asked if private capital can be used for the assumption gap, or does the buyer have to prove where the funds come from? So Steve, on that, it'll be just like your regular loans. They have to show where the funds are coming for closing. So it can't just be, mattress money or whatever. We have to document where those funds, we have to source where those funds come from.
Now, speaking of that, though, there are a lot of sources that can be used, correct, Amy?
I mean, it's got to be a lien on the property.
No, I'm talking about like family help.
Yeah, you can do gifts, you can do 401ks, you can do, a secured second as long as the investor allows that.
Right. So all of the stuff we're seeing, I mean, we're seeing being on the front lines of this, we're seeing people do it in a lot of ways. We're seeing the gifts. We're seeing people who've sold homes. I mean, I think one of the most interesting deals that we're involved with, I have told this story many times. It's a situation where the loan being assumed is 15 years old, and the gap between the sales price and the loan being assumed is $500,000. And I love this deal because if you think about it, this person is stepping into a loan where it's halfway through its term. And as we all know with amortization schedules, interest is front loaded. So the bulk of the interest in that term has been paid. The person sold a home out of state, is coming to Colorado, has a lot of equity from the house that they're coming out of, and they're jumping into a good rate below what they could get a new loan at. But the best thing about it is this loan's almost half gone and the interest side is gone. So, or a lot of the interest side is gone. So I love that deal. So, and these are the real world kind of examples that I think, going back to, marketing this out to get clients, that you should be putting out there into the world, teaching classes on, talking about, utilizing social media posts and stuff like that. Other things, connect with the veteran community if you're in a VA market, like we are. There's all kinds of veterans groups. There's all kinds of veteran organizations. They're thirsty for this information. And what better way to support people who've supported our country than showing them, hey, you've either got to go get a new loan at 7%, or because you've got this, you're the most attractive person to assume another VA loan. You can step in, swap eligibility, and take over a loan and save hundreds and hundreds of dollars a month and thousands a year. So, and once again, buy our presentation flyer, we can integrate stuff for you from us. So let's see here. Let's talk about when you get that listing. I actually think this is the most crucial thing I teach on right now, and that is exposing the listing to the marketplace. These deals will grow exponentially the better we get as agents at getting the information out to each other and to the public, right? So when you take a listing, right, and this may be something you need to check out right now, your MLS is the base place that we put homes for sale, right? Does your MLS have fields for this? Our MLS in the Colorado Springs area does. Almost no agents ever use them for more than 20 years. Matter of fact, I think the default input in our MLS for Assumable mortgage, it was a yes or no, defaulted to no, and you could just skip over it. It then had, if you put yes, you could put in information about, the loan amount to be assumed, the payment, the type of information there. I think it's critical to check your MLS, make sure that you've got some fields in there. If you're not, I would talk to my board about getting this in there. It's really an important thing to put in there. Remark sections, anywhere you can put information about the loan amount, the type of loan, the interest rate, the payment, that kind of information in your MLS so agents and their clients can see it. Then from there, it's about getting it out to the public sites. Now our MLS, even though it has fields for this, the information that it generates out to the public, those fields don't show up, right? So if I have a client who sees one in a search I've built them, they've got to actually ask me, what's the details on the assumption? If you can get it out, if your association allows you to put certain financial data in remark sections, that's great. Save yourself some time. But we really want to get this stuff out there. You can, a lot of the public sites, you can go in and edit remarks that maybe upload in the IDX feed and put stuff in. You can put it in your website, you can put it in different places, but you really want to expose this so you're properly leveraging your client's asset. Because think about it, when we list these homes, what's our job? It's to expose the property to as many people as we can and tout the assets that the home has. If the home's got an updated kitchen, you're going to market it. If the home's got a big lot or a great view or, you know, anything special about the home, you're going to market it. You want to market the asset of the assumable mortgage. What can the buyer take over? And it doesn't mean you're going to sell the home through an assumption, but you're just attracting that much more attention, because if your listing is on the market with an assumable mortgage right next to another home, let's say that is exactly the same in terms of obviously location, but interior features, interior condition, everything else, which home should sell first or for more? Well, I think it's the assumable, because you've got this great payment that somebody can take over versus that home with a conventional loan. Conventional loans aren't assumable, so somebody's got to get a new loan on that house. Let's see. Obviously, shouting it from the rooftops on social media, highlighting the payment difference and the payment savings, things like open houses. I think you should have information on your flyers. I think you should have information at an open house, on your sign riders, even anything and any way you market the property that you can mention this. It's key in showing buyers and their agents that you have a team at Assumption Solutions to help you diligently process the assumption approval to get to a smooth closing, I think is also helpful. If you want to use us, you need to have a conversation with the other agent about what we do and the fact that how we can help their buyer and the fees involved. We have had some agents in our local market that have actually put in the remarks section of certain listings that they're going to be working to process any assumption deals with Assumption Solutions. We're happy to be a resource any way we can. So if you want to do that, that's fine too. All right. That's the bulk of what we wanted to talk about today. You know, our mission obviously is to help sellers get top dollar, help home buyers get the lowest payment, and help real estate agents complete more transactions. And we're here to be a resource. So why don't we jump into any questions that anybody's got?
We'll stop it there, guys. Let's see, Kathy, where's Kathy? There's Kathy. I see Kathy. Again, this is not, if you came in late, we didn't want this to be a commercial for Assumption Solutions. You're free to contact them and work with them. They are here in Colorado Springs. They're doing a great job. My wife is in a deal with them right now, like I said, and it's going great. There is a lot of moving parts to this thing to get it done. So it does help having a company like that. You might have companies like this in your local market. You might be able to talk to lenders, different people that can help work you through some of this kind of stuff. They are available to do stuff. If you want to contact them, you can. But it was mainly to get some discussion going and get some teaching going on this, this whole idea of assuming mortgages, because again, we haven't used these for so long. I've never done one. 21 years. This is the first deal I've had in 21 years where we're in the middle of assuming a mortgage. Some of you maybe have before, but we just haven't. And I know it's just becoming, it's a very viable tool. I think another tool to have in your toolbox, you know, in this kind of market where rates are shooting so high. So let's open it up for some questions, some comments, some thoughts. Kathy, you want to share anything on it? I want to make sure people understand it at least, you know. So
yeah, no, I mean, we had sold one of our houses back in the day. He had mentioned, you know, you could sell it without people getting qualified. We actually sold one of our houses way back in the day, you know, under an assumable loan. And, you know, just to what you said, you know, in the market that we're in, people are very payment sensitive always, but now the interest rates, you know, have doubled over the last year and a half or so. And the buying power is a lot less. So this is just another option that you can have. And like he was talking about, you know, on the video, just to be able to market your properties. If you've got a property that has an assumable loan to it, then it's just one more way that you can use it in marketing and set yourself apart from the house next door that maybe doesn't have an assumable loan. So, you know, that's all so there's several questions, Jeff, in the, I see already in the comment box. You know, I think Adrian had asked about what is an entitlement. You know, I'd say Jeff and I neither are VA experts, but, you know, the VA will guarantee how much a veteran can borrow. So it helps determine how much they can borrow before needing a down payment. And so, and like he said in the video, they can, a veteran to a veteran, that entitlement will transfer to a new veteran. And if they're not a veteran, it stays with the loan. So if a buyer comes along and buys it and they're not a veteran, then that entitlement stays with the loan. And the thing to kind of note, to really, the main thing I would say as a realtor to know about that is if your veteran seller sells that loan or does an assumable loan sale and a non-veteran buys it, then now their entitlement benefit is tied up with that loan, which may mean they may not be able to have much of an entitlement, ability on the home that they want to go purchase. And so, we're not the experts there, but that's the one thing just to consider, to think about, and to make sure that you get your seller educated if they're selling their home on an assumable loan to a non-VA buyer.
So Jason, that goes with your question. So if a VA seller sells to a VA buyer, that entitlement goes away. Like
it goes with the new buyer.
The new buyer takes over the VA benefits, the VA eligibility. That seller now has his eligibility to go buy the next house.
Yeah.
With that, if he sells to a non-VA buyer, it stays on that loan until they either refinance, pay the mortgage off, or sell it and move on to something else.
Right.
So does that answer your question, Jason?
Is that different than transferring a normal VA loan without this program? Because I thought in the past, if you assume a VA loan, it ties up your eligibility. So now with this deal, if you assume your VA loan to another veteran, it doesn't tie it up and you're still free to buy another house.
That's my understanding.
The seller's eligibility comes back to him.
Yep.
Yeah, and now he can go buy the next
they sell it only on an assumption. Now we're only talking assumptions here, right? So
Right.
if somebody just goes sells their house, then that's going to free up their eligibility, right? But we're only talking assumptions here. So if it is another VA, my understanding is another VA buyer, that it frees their eligibility up. And honestly, depending how long that veteran seller has owned it, they may still have some eligibility, even if the original stayed with even if they sell it to a non-VA buyer, there may be still some eligibility benefit to that VA seller, if that makes sense. And that's where you got to get a good lender partner that really, understands all of this, because it's a percentage, I think, of the loan amount. So if that loan on the original purchase for that seller was paid down, quite a lot, and now new buyer comes in and assumes it, then I think that the veteran may still have some eligibility, potentially. So again, I don't, we're not the experts there, but just things to consider and to know when you're selling property, that, hey, this is just one more, as I always say, quiver in your, or arrow in your quiver, right? It's just one more way to maybe market a property, one more way to talk to buyers. That, when we were in the craziness of our market, we had buyers, we all did. We had buyers figuring out where to find $50,000, $100,000 extra cash over appraisal to come to the closing table with. Right. So if buyers can become creative and figure out how to find that kind of cash to pay that much over an appraisal amount, this is just one more way, now that the interest rates have gone up and sellers that are eligible to sell their home with an assumption, then the buyer, if they've got the down payment, the difference between the sales price and the equity in the home, if the buyer has the difference, they can potentially assume that loan.
And like he said, he made that example, great for move up buyers.
Yeah.
Somebody who bought the house several years ago, they got equity in the house. They can now take that equity. Here's the down payment on that next house and get a 2 3/4% interest rate, and assume that mortgage if it's an assumptional mortgage, So there's different things that could happen there. And again, I think for you guys to really take this and keep digging into this and learn it and be able to market with this and teach classes on it, and find out from certain, sellers that you're working with, whatever, that kind of stuff, or put this out there to some buyers that you're working with who maybe have that kind of cash to put down, it opens up a whole new avenue of marketing for us as agents, Sean, you asked about, promoting the services. Let me share the screen here real quick, just so you can see it. This is their website right here. Let me just go to the home screen right here. This is the website. It's Assumption Solutions. Now, again, they're here in Colorado Springs. They're not part of EXP. Craig is not an EXP agent. He's an independent broker. Like I said, I've known Craig for a long time. I can highly vouch for Craig and definitely vouch for what they're doing with this company. You're free to contact them and use them. If you click here on real estate agents, there are some things down here, these marketing materials, one of which is a flyer. I'm just saying you could take this flyer and make your own flyer, somehow, some way. If you've got some people, you could download this. Here's their presentation, which here's that slide that talked about, the difference in price. A 7% rate on a $400,000 house, there's your monthly payment. There's a 3.1% rate, difference of $1,000. And then this one here I thought was just big because, what they could go purchase, whatever, a $500,000 home is what they could qualify for at that 1708 payment at a 3.1% interest rate. The rates here, 7%, it drops their purchasing power down $180,000, which is huge on the kind of home that they can buy. Yeah, Jason.
I have a question and you may not know the answer to.
Sure.
I know as a buyer, you have to buy it as primary residence, but as a seller, can you sell an investment property and assume that loan? As a seller, can you advertise that the loan's assumable as an investment property? I'm selling a couple of my investment properties and I want to know if I can use this.
It's a good question. I would tell you to call Craig just to know for sure. Call over to Assumption Solutions and ask him. My guess is yes.
Okay.
I think it's the buyer has to, they're the ones that have to have the primary residence.
And as far as the marketing, I know this kind of throws a wrench in things, but if say I've got a VA seller and they don't want to tie up their VA eligibility, but they're willing to use this program to market the selling. But if they have a buyer that's not a veteran, they don't want to tie up their VA eligibility. So it's probably best just to not market it and have those private conversations with individual buyers, huh? Because you can't discriminate and market it and say, oh no, you're not a veteran, this doesn't work for you.
Right. Good point. For sure. Paul, how do you get around the 90-day close? I mean, again, I think it's probably it's on the servicer side. I know there's a lot of stuff that has to go into this. I know when I did short sales back in 08, 09, 2010, I mean, we were at the mercy of the banks. It's just, and those took sometimes, 90 days, man, that would be a miracle if we got through it in 90 days. There were many times 5 and 6 months, but that's just what it was back then. We did hundreds of them back in the day. So I don't know if there's a way around that. I think it depends on the servicer and them getting all their moving parts. I understand where it's not something they want to do, but like she said, she made that point that no, this is part of the benefits of that loan, So, again, to have a good person, on your side that can talk to those lenders, maybe that don't want to do it or say that, well, we just don't do that or we can't do that. It's just that they don't want to because they'd rather get them into a 7% loan.
I guess all the interest they've already collected on the front end on that loan, they want to recollect, for a new loan.
Yeah.
But, also, Paul, I would just say, obviously, as always, it's right setting the right expectations for your client and your seller, and partnering with somebody like these guys with Assumption Solutions, because this is what they do a lot of, and so partner with somebody that knows how to expedite it through as fast as possible. But every servicer, like Jeff said, is different. And some may go faster than 90 days. Some might be 120. She said some could take up to 120 days. So
that was the core of my
sure
question.
that your client understands, the potential longevity.
Yeah. For sure. Has anybody else done any of these? Anybody done one before? They're just not common. but I think it's something, again, most people just don't know what to do, don't know how to do them. Again, I think it's something to really start digging into, because as these rates are just kind of hanging here, and I don't think they're going down anytime soon. They will eventually, but I just think, again, here's something to dig in on. How could you
Well,
market?
I think, Jeff, to your question is we've not been ever in a market. I mean, in 25 years I've been in the business, we've never been in a market like we're in now. We're never been in a market where the interest rates were 2.5%, 3%, and then 3 years later they're 8%. Which is why right now this is a potentially really good marketing arm for agents, for that reason alone.
Yeah. Most agents don't know about them. They don't
No,
even think
they
about them.
don't.
This isn't
They
even a
don't.
thought to them. And again, with my wife being in one, I just thought, man, this would be a great thing to talk about here.
Yeah.
And just, again, it's not going to apply across the board, but if you can dig in on this a little bit, I guarantee you have buyers who would jump at getting a 3% interest rate right now.
Yeah.
And I'll tell you right now, one conversation we're having right now with a lot of our prospective clients, these people have kind of put the brakes on, is like, look, here's another thing for all of us to think about. Right now, with the rates being where they are, there's a pent up demand that's being built in a big way. Buyers sitting back, waiting on the rates to drop. So one of the conversations I'm having with people is like, look, again, totally your call. You got to do what's right for you. But here's something to think about. We can wait till the rates drop, and all of a sudden, what's going to happen? If the rates drop back down, even to a 6, 5.5, whatever, which will come eventually. I really, that's coming. When that happens, the flood of buyers that's going to hit the market is going to be huge. But what's going to happen now? That home that's been sitting there at 500,000, now they're at 475, and now you get this flood of buyers. You're going to have multiple offers. Now you're going to be paying 550 for that house. Is it better to buy it at 500 right now, or maybe 475? You get a little more bargaining power. Yeah, maybe a 7.5% interest rate. If it drops to 6, you can refinance it. Okay, if and when that happens, I don't want you to get into something that's going to cause you any financial harm. Like, don't do it if you don't feel good about that. But that's the thing to think about.
Yeah.
There's a flood of buyers, drives the prices back up. We're back to what we were a couple years ago with that market. Or, do you go buy it now? You can afford it. It's a little higher than you want, but you can afford it, whatever. And then the rates drop and you refinance it. But now you're getting that home for 475 instead of 550 with multiple offers you're competing against. That's something for buyers to consider and to weigh out and wrestle with a little bit and think about. How can you help some of the people with that? Because that is what I think is going to happen. As soon as these rates drop a little bit, get ready, because we're going to be right back to that kind of market, I think, pretty quick. I mean, there's going to be a flood of buyers. There's a demand that's building right now that's huge. So
yeah,
things to consider. But dig in on this, guys. I mean, we can have more talks about this. Talk to your local lenders, talk to people in your office, talk to your brokers, whatever. I mean, we can all have conversations about this. You could become an expert in this. There's just not many people talking about it.
That's right.
It's a very viable thing that could add to your marketing, bring you more sellers, bring you more clients, get you more deals. For sure. There's lots of ways to do it. Those move up buyers, I think right now, especially pulling that equity out to be able to put that towards an assumable mortgage could be huge. So,
well, and to his point, I just want to end on this. To his point, as realtors, we need to get better at marketing that, because I mean, if we found out from our sellers that they had an assumable loan and we were marketing that, imagine, like, it makes me think how, like, I've got buyers now. It's like, man, if I could find a good assumable options for them, they would buy today. Right. So, as agents, we should learn all of this, and we should have those conversations with any potential sellers so that we can then market it, to, and probably potentially, even with these crazy rates, right? If you can market a house that it's 3.5% interest or 3% interest, I mean, imagine the potential multiple offers that you're going to be able to draw in for your clients.
huge.
So it really is a huge opportunity.
He made mention, market that with a sign. Well, just a plastic sign that, for $10 that you go get from a sign shop, put that out front, put a sign writer out there, do open houses and market it that way. Think about the kind of traffic you're going to get with that. The other buyers you're going to pick up because of marketing a house that way.
Yeah.
It could be huge. Okay.
Yeah.
So anyway, lots to think about. Appreciate you guys being here. Not normally what we do, but I thought this would be just a good thing to talk about. So, Definitely great to have you guys here. Next Tuesday, first Tuesday of November. So we will do our open mastermind. Bring your topics, bring questions, bring ideas. This is one where we just all pitch in and any ideas we can throw around to each other and talk about things. Those are always good as well. So that's next Tuesday, first Tuesday of the month, just our open mastermind. Okay.
Well,
So,
and real quick, tomorrow we're having a special training
that's
with
right.
Rob Flick. So same link tomorrow at 10 o'clock. If you're looking to build your organization through some rev share, he has, 20,000 agents in his organization. So he's doing a special training for the Freedom Team tomorrow. Same link, same time. So come tune into that if that's something of interest that you're looking in for your business in 2024.
Definitely. Guys, thank you very much. We're always here to help you.
guys.
Reach out to
Thank you
us. Have a
very
great
much.
day. Thanks,
Bye-bye.
everybody. We'll see you soon. Bye-bye.
Wow.